HDFC Bank. So earnings season kicking off full throttle. Let's take the conversation forward. Abhilash Narayan, Senior Investment Strategist, Group Wealth Management at Standard Chartered Bank, is now with us. Abhilash, thanks very much for joining in. Great to have you on the show. We're in interesting times because the litmus test has begun, right? Corporate earnings, and they're coming in thick and fast now. Just your overall thoughts before we start talking IT or what banks can deliver and how you're poised. What have you made of this whole consolidation phase that the market has been in, the slight uptrend that we've seen in the last week and a half or so? Do you expect the market to continue to be in this band, or do you think that we can perhaps start getting some sort of an up move or maybe a down move, basically a directional move over the next few weeks?
Well, on our end, we've been highlighting that the recent rally that we have seen in stocks could actually be a good opportunity to rotate out of equities and allocate a bit more to bonds. So from our perspective, we see a very high likelihood of a recession in US and Europe, so around 80% probability of that happening in the next 12 months. And that's why if you look at the rally we've seen globally, we think that it's starting to look a bit frothy. So in US, for instance, most of the rally has been driven by PE expansion. And to a certain degree, that's what's happened in Europe as well, with German and French indices, really hitting all-time highs or multi-year highs. So, we think that if you want to stay in equities, rotate into Asian equities. At the margin, investors should consider increasing allocation to bonds, given that we are probably close to the end of a rate hiking cycle for most of the major central banks, RBI included.
So you're saying you would prefer bonds over equities right now in the Asia-Pacific region?
Yes, that is true. So at a headline level, we prefer dollar-denominated bonds within Asia as compared to equities. And that's down to a very simple fact. So if you look at the all-in yields that dollar-denominated bonds offer in Asia, that's higher than what you get in some local currency markets as well. And that's happened for the first time since 2009, 2010. So that's quite attractive in our opinion.
So what would be your equity allocation, the recommended equity allocation, if an investor has a choice between dollar-denominated bonds and equities? What was it, say, a year back? And what is the equity allocation down to?
Well, if I recall correctly, it varies according to different investment profiles, but we were around 10% overweight equities maybe 12 months back, and that has now shifted to around 10% underweight. That being said, we do see Asia as a bright spot. Leaving aside US and Europe's growth concerns, we think Asia is the bright spot as far as growth is concerned. So we think that, if you think about Chinese equities, they'll deliver earnings growth of around 16.5%. And for Indian equities as well, we are looking at a 15% EPS growth for FY24. So, valuations are a bit stretched, but we still think that from a earnings growth perspective, we are on solid footing for Asian equities.
All right, got that. Abhilash, thanks for joining us. This is Pavitra. If we can talk a little bit about the US now, because we did get that inflation print that came out. We also had the Fed minutes last night. Take us through how you're reading this. Inflation has eased, but it is the Fed minutes which are sounding a little bit more cautious, right? At least in terms of what they're saying on a recession in the second half of the year. Your own reading on this?
Well, if I take inflation print, I think it had something for everyone. So if you are in the camp that inflation will come down, obviously look to the fact that year-on-year inflation declined from 6% to 5% at a headline level. But if you are one of those people who think that inflation is sticky, then you could look towards the core inflation. So the inflation figure that excludes volatile components such as energy and food. And actually, if you look at it, the core inflation increased from 5.5% in the last reading to 5.6%. And I think given the fact that inflation has proven to be sticky and Fed has said that it will remain data dependent, we think that the latest inflation print hasn't given Fed enough backing to pause the rate hiking cycle. So we think that short of a renewed scare in US banking sector, Fed will hike rates by 25 basis points to 5.25% in the upcoming meeting in early May.
Okay, so Abhilash, I'm going to now come back to Asian equities and India. Given that in any case you are a little more optimistic on bonds than equities, to go back to my colleague's question, in the portfolio, how much equity allocation are you recommending right now? Within that, how much would be India and why?
Well, if I just take an average balanced allocation, right? You can have a conservative or a aggressive allocation. If I take a balanced allocation, we are looking at equity allocation of somewhere around 35% versus a benchmark of around 45% if you were neutral on equities. So we are about 10% underweight on equities. Now, if I talk about Indian equities allocation, I think at a headline level, we are neutral on Indian equities within Asian context. And one of the things that really stands out to us is that we had moved from overweight to neutral on Indian equities at start of the year, and that call has played out. India has underperformed global and Asian equities. But what that has meant going forward is that valuations have become less expensive on a relative basis, right? So if you look at the Nifty P, that's broadly in line with long-term averages. And if I look at the Nifty P versus MSCI Asia Japan, it was trading at a 120% premium back in October 2022. Now that is down close to 50% premium. So on a relative basis, Indian equities have become less expensive. And I think going forward, that along with the strong earnings growth should mean that Indian equities perform broadly in line with Asia Japan equities, but they have a high likelihood of outperforming US equities in our opinion.
Got that. What will make you go overweight on India? Currently, you're neutral. What would it take for you to go overweight?
I think a couple of factors. So first one is we have this overhang of a potential recession in US and Europe. And while India on its own has fairly strong growth trajectory, given the interconnected nature of financial markets, if we do end up seeing a recession in US, then that will have a negative impact on global equities, Indian equities included. So, if we do get indications that US recession is becoming less likely, or, the Fed is pivoting towards cutting rates, which reduces the risk of recession, then that could be a positive catalyst for Indian equities. And secondly, I think it's the relative trade-off between expected earnings growth and valuations. So, as I mentioned, Indian equities are trading at around 50% premium to Asia Japan equities. So if we do see further underperformance of Indian equities, and that leads to that compression of that premium that Indian equities are trading at, then that could actually be something that makes us a bit more optimistic on Indian equities going forward.
All right, Abhilash, we're going to leave it on that note today, but thank you as always for taking out the time and speaking to us. That is Abhilash Narayan of Standard Chartered talking about the outlook for the market, also saying that on India, they did turn from an overweight rating